Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, traders, investors, money managers, strategists, authors, educators, learning more about how they approach the market, what tools, techniques, and routines they use to make better investment decisions, what lessons have been learned through their successful careers in the financial industry, and what their investment toolkit is telling them about the current market environment. Really fascinating guest to share with you today, Ian Reynolds. Ian is a director at Suberia Capital, originally from the UK, but now based in Brisbane, Australia, which is where we spoke to him earlier today virtually. Ian got his start in the industry in the early 1990s, working as a market maker in the currencies and money markets. Has had a number of different phases in his career, working for a number of financial institutions. He's actually launched and sold a couple technology companies, early adopter, early investor in Bitcoin, and now his current role at Suberia Capital, including a newsletter he now has released on Substack for investors. My conversation with Ian touched on, I think, a lot of those different areas. We talked about some of his early formative days as a market maker, what that life was actually like, how he identified opportunities, how he managed risk, and how he managed the mental challenges of having a lot of zeros in your account, putting a lot of money at risk every trading day, and just thinking about that P&L. We talked about his transition from making markets to following trends, and how his role as how his approach as a trend follower has really changed how he approached the markets. And we applied that trend following toolkit to a number of different charts, from equities, global equities, US equities, gold and commodities, currencies, the dollar, and certainly cryptocurrencies. We talked about the US dollar as a reserve currency. We talked about Bitcoin and Bitcoin dominance in the crypto space and potential upside for Bitcoin given its recent pullback here in August and September. We talked about stocks making new all-time highs, the weakness in the dollar and how that has certainly made non-US markets thrive compared to the US. And a lot of other things in between. With someone like Ian, it's just a fantastic opportunity to sit down with someone who's had so many wonderful experiences as a trader, as an investor, thinking about sort of these short-term flickering ticks that we often get so caught up with. And with my conversation with Ian, it was great how we immediately started bringing up some longer-term charts. I asked him about the dollar. I'm bringing up a monthly chart of the dollar going back 20 years because that's sort of time frame we use to sort of frame out where different securities were within some of their long-term cycles. This is a conversation that touched on a number of different markets and a number of different areas of trading and investing. I hope you find it as enjoyable as I did. So please enjoy this discussion with Ian Reynolds of Suberia Capital. So very excited to welcome Ian Reynolds to the program. Ian is a director at Suberia Capital, coming from Brisbane. Is that right, Ian?
That's right. I live in Brisbane, but I'm from London.
Very, very good. I mean, I've heard of you and your work, Ian, and I'm so thankful that you came on the show today. I feel like we're recording this early September 2025. I feel like our cup runneth over of different market-related things to talk about. So we're going to get to commodities, we'll get to Bitcoin, we'll get to some of these other things in a moment. But just to start off with, your background is an interesting one. You started really as a trader, market maker in the currency kind of money market space, right?
Well, firstly, I started at a company called Manufacturers Hanover, which was a US bonds trading company in London. And soon after, they got hoovered up into Chase and whatever that ended up being called. Then I moved to Bank of Nova Scotia, where I was on the trainee program, and I learned to become a market maker in spot Canada, which is obviously their big focus, and some other currencies as well. Did that for 7 years. Traded my own money on the London International Financial Futures floor, which is the equivalent of the pit in Chicago.
Yeah.
But only financial futures, no pork bellies or anything like that. And then I worked at Bank of America and Nice Bank Q8. And then I retired, came to Australia with my wife, who's from Australia, had 6 kids, unretired pretty damn swiftly. Been trading my own money, founded a number of tech companies, early investor in Bitcoin. Here I am.
That's a pretty decent background, Ian, all around. I'd love to ask you with that. I mean, when you think back to your formative days as a trader, just getting your feet under you, being in the, in London on the floor of an exchange, any formative lessons or any painful lessons learned in those early days that helped shape you into the investor you are today, or how I guess you understand the markets today?
Yeah, so obviously the grounding you get being a market maker is that you cannot escape the price action. And if you're in a small market in London time, at least in the Canadian dollar, you've only got 4 exit possibilities.
Right.
So only 5 of you quoting really. So we're the wholesale traders, market
Yep.
makers. Other banks, come to us for the price. And how you deal with losses is your first big challenge, and that happens pretty much on day one.
Sort of baptism by fire, right?
Absolutely. And when you realize that you have 200 other traders there to support you, then you become part of the team and you all help each other. So it's a really critical team game environment.
It's so interesting. So what year? I mean, what years were those when you were sort of just getting started? What general era were we in?
1990.
Yeah, right. So I mean, the world's changed quite a bit, right? I mean, tell me a little bit about just just the structure. I mean, the market structure, just the nature of the interplay of different market participants. I mean, how has that journey been, and what strikes you the most in terms of how things are different now versus when you were just learning the craft in the early 90s?
Yes, so market structure is really different. And market
Yeah.
technology is very different. So back in the dinosaur ages, it was pre-internet,
Yeah.
but Thomson Reuters wired up all the banks globally. So we actually used things that you have on your iPhone today back in 1990 to trade with. So like instant messaging, we would have them on Reuters screen. I'd have 50 Reuters screens in front of me.
Yeah.
So the technology was limiting who you could trade with, right? We don't have platforms like Robinhood or Revolut aggregating retail funds. It was unheard of back in the day. So all the flows are very much to do with proper higher level finance, people buying factories abroad or whatever it is they're doing,
Yeah.
and commodity switches and stuff like that. We don't have these pools of small retail investors that obviously do move markets now.
Yeah.
And the structure of the market is such that 5 people, 5 banks are the market makers, the wholesale market makers for a very big market. I would probably turn over $10 billion a day on average.
Right.
So I'd have 5 people working for me. So I've got the other 4 banks that I can call, and I've got some other banks that I could call, but they probably won't answer me. And if I did call them, they'd probably call them the other 4 banks that would call me. So, and then you get, it's like an onion. There's smaller and smaller levels in terms of amounts. And, I would make the price that the bank makes.
Yeah.
And 4 other guys would quote different amounts and whatever. But when we get a $1 billion commodity switch, I'm the one that's getting hammered.
Right.
If you get the trade, you're going to lose money because I can only get out $25 million at a time and $1 billion is coming in, for example. And if I miss the trade, everyone's going to call me to get out of the trade, so I'll lose money there as well. So how you deal, your whole day can be ruined on that one thing, but you've got to get yourself out of it. You're protected by the bank's orders. So you have buy orders and sell orders.
Yeah.
But you also have stop losses behind those as well. So
Yeah.
what the bank's ethos is, it's okay to run the stop losses for our customers, but the price better stay below it or above it. Otherwise, those customers are going to be asking why they got their stops up. Right. So which is a really double-edged sword when you've got $1 billion to get rid of. So you really learn to be ultimately flexible.
Yeah.
Because you've got to change your mind all the time. So the market structure is literally that, like an onion, and you're in the middle, and you can't escape until Toronto comes in to find out how underwater you are every day.
It strikes me as you were describing that a number of those things, Ian. This podcast is called Market Misbehavior, and that title is meant to, remind people of the mental challenges, right? And the hurdles you have to go through of just going through the day-to-day practice of trading, investing. I'm sure many of my listeners don't have that many zeros involved in their account as what you just described. But I mean, when you're in that sort of environment, and even today, when you're thinking about your portfolio, how do you address the sort of mental, state of dealing certainly with uncertainty, with the potential for loss? What tips and tricks do you have for people just getting started in trading to try to navigate that and not lose your mind the first time you lose the trade?
Yeah, so having been a market maker really teaches you about P&L and how to manage it, because we're not paid as market makers to make money.
Yeah.
We're paid to add liquidity.
Yep.
And Ian, like one of our big customers was Ford Motor Credit, and you can imagine they were doing some pretty sizable amounts. And we had to get the spot deal because we wanted it, because that guaranteed us the next bond placement where the bank makes a whole load of money as long as Ian can lose some money on the spot trade. So, but at the end of the day, at the end of the year rather, I have to make money, otherwise I don't have a job.
Yeah.
So there's lots of things change, and this really teaches you that agility is the key thing in markets, but you can be over agile. Not just be reactive. So you've got to be proactive. And I quite often talk to people about what it's like being a market maker, and it's the absolute opposite of being a day trader, for example, or an investor, is that I have to have a large position to quote against at any one time.
Mm-hmm.
Otherwise, I've got no options. If I'm right, I might make a little bit of money on it, but at least I made some money on it. If I'm wrong, I'll lose some money. But if you haven't got a position, you'll always lose money on it. So, and day traders ask me all the time, why does the price always change when the time zone changes? People like, you walk in, I've got to have $300, $200 million spot position to quote against. So you come in, you go and buy some, go and sell some, and that's what you got to quote against. So you see a very distinct dislocation around time zones.
Yeah.
But it gives you that, having done that, it really gives you the idea of agility, but it's a different type of agility based on the different time frames and obligations.
For sure. So my formative years as an investor were at Bloomberg in New York. And so I spent a bit of time working with currency traders and eventually focused more on technical analysis than anything. But I remember looking specifically at the New York Open, the London Open, the Tokyo Open. You could see exactly what you just described, those initial movements when you thought of it as like three kind of closes and opens during the trading day. So through your career, Ian, you've now obviously gone through a series of phases, and now a market practitioner, market strategist, investor here in 2025. How would you describe your investment process now? And I'd love particularly to learn what sort of technical analysis, trend following, those sorts of tools. How does that have a part in your process, and how does that fit into everything else as you're trying to understand the markets?
Yeah, so as what I would call an investor now, I want to jump on trends like we all do. So spotting the trends first is key, because there's no point spotting it last. So what gives you an idea of what the trend is? Well, it can't be something like moving averages, because they're in the past. So those old parallel channels I find really helpful to frame what is actually a trend. The price doesn't have to adhere to that necessarily until it really does. I.e., when you start to see a breakout or something like that, it's not a breakout until it is a breakout, right? No one can tell you what that really means until you have at least 3 points of contact, in which case you have a framework, right? So you've got something that's fixed. And quite often, if it's a short-term framework, especially in something like Bitcoin, the moment you put that parallel channel, it's broken, almost by definition, right? But that gives you the framework of higher highs, higher lows, and the opposite. So at least you have a framework. And if that's not working, then you get out of it, because it's not a trend, right? And maybe it goes into a horizontal or a rectangle, and you can play the ups and downs either side of it, but that's not kind of what I do.
Right.
That's more intraday trading, and good luck to you doing that.
I would describe myself very much as a trend follower as well. So you're speaking my language. You're talking about higher highs and higher lows, defining the channel, identifying points of contact. I think that's all very well described. I appreciate it a great deal, Ian. Let's get to some of the current markets if we could. I mean, there's so much movement happening here in the last couple weeks, last couple months, and I'd love to just get your sense of where you're at. Let's start with the cryptocurrency markets, if we could. As you mentioned, you were sort of an early investor, early adopter in the crypto space. Bitcoin coming off of a peak around 125,000 in August. It's pulled back to around 107, 108, and now kind of mid-range, sitting above 110,000. I know a lot of traders, I mean, watching the incredible rally off of the April lows, felt like stocks, Bitcoin, all kind of moving up together. Now Bitcoin's come off in August, now sort of languishing a bit. Do you find more reasons to be optimistic or pessimistic when you're looking at Bitcoin now, and why?
So zooming out, Bitcoin to me is the antithesis of the current monetary system, i.e. it's only worth $112,000 because everything else isn't, i.e. is pretty worthless. And that's a huge topic, obviously. So the trend in Bitcoin is up until the current financial system is saved by a default or whatever it is. So I'm just buying it on dips, but those dips can be horrendous. So I've actually, since 2017, took profit entirely on every 4-year cycle. But this one I'm not, because I think that we've seen very few pullbacks. And those pullbacks have been well supported by the macro thesis that, firstly, it might be digital gold. It's not, but some people think that. But mainly that if you're an American investor, you are normally American-centric, and there's huge pools of money out there. On the 20th of January, Mr. Trump got in, and lots of American companies, investment companies, pooled funds, whatever you want to call them, decided that there had to be some non-American diversification. And we've seen money go into Europe since then for various factors, but a lot of it has been in Bitcoin, and the way that the trust rules are set up are getting changed with, the old-fashioned players. You look at the CRE market, where those old-fashioned players like, pension funds are getting absolutely hammered. Soon they're just going to go, well, all of the things I've invested in for 100 years, whatever, they don't work anymore. What can I do? And I think Bitcoin has to have a place in it. Is Ethereum going to catch it up? I don't think so. It's a different thing. Love it though. It's a different thing. So to me, it's buying on dips, but those dips are getting less.
Yeah, I mean, Bitcoin, the history of Bitcoin, as you alluded to, has had significant drawdowns, right? I mean, there have been pullbacks, but sometimes they've been, I mean, way more, obviously significant than in the equity space, for example. That's sort of been the history. And to your point, we really haven't had that much of a painful drawdown in quite some time. You had mentioned, Ian, with the sort of the, I guess, the path of institutional adoption. You were getting into Bitcoin, I think, earlier than the average investor. Now we've obviously seen, with Bitcoin ETFs and, trusts, and now ETFs that are pretty widely, very liquid here in the US. Certainly this implication that more and more investors are able to, and certainly the flows would indicate, are definitely participating in Bitcoin. What's your sense? I mean, I would argue the real long-term opportunity in Bitcoin probably driven in a lot of ways by institutions taking more meaningful positions and starting to adopt. Where do you think we're at in that transition from institutions not touching this freak thing that's a sideshow that no one really cares about, to being a central, sort of digital currency that people rely on, and that institutions participate in? How much of the upside is still left with future institutional adoption? Does that make sense?
Yeah, absolutely. So firstly is, can they invest? Well, they can just invest. Let's say that in the rules may have changed for them. So can they actually do it? Well, yes, they probably could. Will they do it? Well, that's a different matter. Have we taken enough volatility out for them to be confident to invest in it? So even it going the right direction in volatility for them is a problem for them because they have to rebalance their funds.
Right.
And normally, if Bitcoin's gone up a lot, then these days, the other things they might be investing in, let's say bonds, haven't. They've gone the opposite way, right? And suddenly, Bitcoin becomes the predominant winner of your fund. And what sort of fund are you? You become a Bitcoin-only fund or something. You know, it's really challenging to have a decent allocation, I think. You might have a diversification allocation, but to have a real allocation in it is still for the crypto-only funds.
How do you think at this point? I mean, I've heard a lot of people debating whether Bitcoin was the, sort of the initial crypto that becomes popular, but is it the one that really has the staying power? Obviously, things like Ethereum have outperformed Bitcoin in 2025. How do you think about Bitcoin's dominance versus other, I guess, more popular coins like Ethereum versus many of the altcoins that obviously get a lot of headlines recently? Where are we at in that Bitcoin dominance? And should that be a concern for Bitcoin investors going forward?
I mean, haven't we heard this conversation for the last 10 years? I mean, if you ask a person in the street how many cryptocurrencies are there, could they name 5? I doubt it.
Fair point, right?
I mean, it's the brand, many people say this. It has the track record, and time in financial markets is a critical factor. It's still young, but it's not as young as all the others.
Yeah. No, well said. And 100% right. I feel like that discussion has been had for so long and continues. Bitcoin continues to be sort of top of mind for most crypto investors. On your website, Ian, there's a great quote as I was looking through and preparing for our discussion, and you had said, "When gold moves, you need to listen." Gold has certainly been moving here recently, right? With gold making new all-time highs, silver as well. What's the message you think investors should be listening to with gold making new all-time highs at this particular point?
Well, the backdrop and an investor listens to what's happening in the world around us is the US savable as a functional financial entity? Not a popular subject in America, I would have thought. But nevertheless, everyone's thinking about it. The public are thinking about it, right? Far more. 10 years ago, they wouldn't have known what the debt of America was.
Yeah.
So far more sensitive to that, which means voting power as well to some extent. If you're a system that is underpinned by the risk-free US Treasury, anybody in financial markets looking at risk would tell you that's completely nuts. If the US Treasury bond, let's say, is underpinning everything, so when you put your money in the bank, it gets converted to some sort of US Treasury bond, and then it gets circled around in the financial system. When you think of that, that's a crazy risk to take. When you think of what Scott Bessent is trying to do with stable coins, I get what he's trying to do. He's trying to knock out more treasuries, absolutely, and why wouldn't he?
Yeah.
But if you're a crypto investor to start with, and you go, well, I think they're trying to pull the rug out of us here because here's lots of unperforming or badly performing assets. They want to push into a vehicle called a stable coin. Is that not somewhat akin to a collateralized mortgage obligation in 2007, 2008? Right? And you go, well, okay, how do I measure and de-risk what I've got against that global contagion? Well, what can you do? You can buy houses, but that's a bit idiosyncratic, like lots of people doing it, right? BlackRock and whatever. You can buy something fungible with a nice, consistent price like Bitcoin. they can have some other strategies. But in reality, it's reawakened gold from its 7-year slumber. Is it 7 years? I don't even know. And it's kind of an easy trade for those that are older type institutions. I can go and get the sign off in putting some money into gold bullion much more easily than I can to put some money in Bitcoin. So let's go put some money into gold bullion. For the older of us and older, some of them can remember gold coins, silver coins when they were legal tender before 1971, right?
Yeah.
And in your country, you'd have to be really old to remember it because the Fed confiscated them in, when was it, 33?
I think that's right.
It's kind of like when everything goes to nothing, you'll still want to have some gold coins underneath your bed. And with that backdrop, why wouldn't you? Every month we hear that the central banks are buying gold and now have more reserves, foreign exchange reserves in gold than US dollars. What is it that would make you not buy gold? I can't think of anything. I mean, normally that is a red flag scenario, right? But in this case, it's produced a massive trend that we are, I believe, at the start of.
Very interesting. From a trend following perspective, it's something we've certainly been tracking here very closely since, really since late 2023, right? You've had this incredible uptrend in gold and silver, by far outperforming U.S. equity benchmarks, to be sure. Can we talk briefly about the U.S. dollar? And the dollar obviously remaining incredibly weak for a U.S.-based investor. This has meant non-U.S. markets look incredibly attractive and have outperformed the U.S. Even though the AI trade has fueled a lot of gains in U.S. equities, that's been shadowed by much stronger gains outside the U.S. And the weakness in the dollar has certainly been a part of that. Do you see signs and conditions suggesting further weakness in the dollar? How do you think about it after the weakening that we've experienced so far in 2025?
So the dollar is in a 15-year uptrend, but at the very bottom of that uptrend currently. So pivotal moment, and price action is really reflecting what we're experiencing, i.e., we have a Federal Reserve battling the Treasury. We have a Federal Reserve relying on statistics that would appear to be incorrect or loaded politically, or just plain wrong. And you have a market supported by the risk-free asset where lots and lots and lots of incumbents have significant haircuts that have to be taken. And those haircuts will have to be taken by the Fed. So when you look at the secular downtrend in the dollar, if I can call it secular, for 9 months, you have to say there's a real purpose behind that. So, okay, downtrend, 16 years, I think it is, uptrend channel. Would I be buying it here? I'd be looking for this definite break of it for sure.
Yeah. So, what specific tools or techniques? So the dollars you mentioned, right? And I had a long-term chart, sort of a monthly chart of the U.S. dollar going back to the mid 2000s. This is like the 2008 low, all the way to where we're at now. So we're in this like big kind of long-term uptrend, but we've pulled back obviously quite a bit here. What sort of tools and techniques would you use to determine, okay, that's an inflection point? That's where I need to start betting on a stronger dollar? Or is it more of a macro call for you at this point?
I think it's a bit of both. So, to measure the price of the dollar is a difficult thing to start with, right?
Yeah.
So I normally look at the Dixie, but it's just simply because it's a future that's open most of the time.
Yep.
So really, what are the inverse of this? So like Bitcoin and the traditional economy, we have to look at what else is happening. So if you look at the euro, for example, that's breaking out. If you look at the Aussie dollar, that's trying to break out. If you look at cable, i.e. sterling against the dollar, that's breaking out. So when all the other currencies break out against the dollar, is the time that tells you the dollar has broken down, because it's the cross flows that make it, as you see, flows into those lucky currencies that get the investment, like the euro, from the yen or wherever it is. Those are the flows that really tell you at that critical time that the dollar is going a lot lower. I personally think we could see the dollar higher, a lot higher at some stage, as de-dollarization happens, proper de-dollarization, because the nature of, and just to back a little bit, part of being in the European market earlier on is that Eurobond issuance is massive. So everyone wants to borrow in the dollar, right? Because it's cool. And we know that no one ever pays those loans back, right? Because they get shrunk to such a little amount by debasement that it's not worth bothering about, but people still need to borrow to finance various activities.
Sure.
So if you are issuing a dollar Eurobond in Europe and you have to pay, just for example, the coupon every year, you've got to buy dollars to do that. If you're forced to get out of that loan, to repay those bonds early if you can, or just because they mature, then you have to buy dollars. So there is a big dollar blip somewhere coming, and Brent Johnson and milkshakes and all that sort of stuff talks massively about that, but it has been since 2018. When does this happen? I don't know the answer time-wise, which is the most important factor in markets, not price. But when it does happen, it's going to be massive, but very short-lived. And that's the time when you short the dollar, if you're lucky enough to have thought all of that and be presented with it.
Yeah. At the risk of ending our discussion, Ian, on a dark note, I'm curious how you answer this question. If you think, there's been a lot of speculation, obviously, with geopolitical upheaval and certainly the administration in the U.S. that we at some point we move away from the dollar as the reserve currency. That could be other currencies, could be a digital currency of some sort. Where do you see that headed? Do you see a point, and how far off do you think that is, where people would legitimately say, okay, the dollar is no longer the reserve currency? Or do you think that's just kind of fearful discussion now, given the upheaval that we've experienced recently?
I think it's a different thing, to be honest.
Yeah.
Is the answer, in that currencies have been all over the place for the last 600 years, right? Every time you get a king or queen or an administration that says, yep, you can redeem your currency in gold, silver, stones, whatever it is, the media go and print a load of money and can't redeem it. We saw that in 1971. In this day and age, the biggest trade vehicle is the internet.
Yeah.
So why wouldn't we have the currency of the internet? Why do we need countries anymore? And as the EU becomes the state, which I would believe it will, mainly because France implodes, but we'll go to that stage where the EU becomes a massive pole in the multipolar system, and the US becomes a lesser pole. And I've got some wild theories about that, how it happens. And you have China and Russia, whatever happens there. The equally sized poles go, well, this is completely stupid having all these currencies. Why did we bother employing Ian for all these years when we could just have one? And why wouldn't you use Bitcoin?
Right. Oh, and that wasn't as scary as I thought. You make it sound very straightforward, and so I'll take that as an optimistic view of where we could be headed. Ian, listen, this has been such a pleasure. As I mentioned, I've followed your work, and I enjoyed reviewing your newsletter to kind of prepare for our discussion. Where can we point people to learn more about you? And I know you have a newsletter that you share on social media. Where can we point people to learn more about you and your work?
Yeah, so I've just started a Substack channel, and most of my personal stuff will be on there going forward. So hopefully you'll be able to put them in the comments for me, or the notes for this interview. And basically go to Substack, and I'm available through the chat there, most times.
Very, very good. We'll definitely include a link to that. Ian, thanks so much for joining me. I love telling my kids I'm talking to someone from the future, which is what I get to do based in the West Coast of the U.S., talking to someone from the future of tomorrow. But thanks for jumping in a Brisbane morning and sharing some thoughts with us today.
My pleasure. Thanks, Dave. Really enjoyed it.
So really fun conversation with Ian Reynolds. I feel like we just scratched the surface of Ian's expertise. Hopefully we can continue this conversation further on. But I know from reviewing and looking into Ian's work and having this interview really opened up my eyes to different timeframes, right? And so interesting to think about things like Bitcoin, Ethereum, the US dollar, gold, stocks, not just as day-to-day movements, but as fitting into these much longer term cycles, right? When we're talking about, Bitcoin dominance, when we're talking about, the long-term trends in place for gold and what this recent breakout means within the context of a much longer-term trend. A number of my guests have implied something along the lines of "when in doubt, zoom out." And that was a quote that was in my head as I started bringing up charts and immediately started looking at, instead of daily charts, weekly charts and monthly charts. Ian, admitted to me before we started, he's like, "I'm not a technical analyst. As a matter of fact, as a market maker, you work more on flows as opposed to, price action." So it was less about, technical indicators. But as I talked with Ian and started asking him questions, he's very clearly a trend follower, which he openly admitted. We talked a lot about trend following and thinking about some of those longer term channels. And that really helps, I think, given the moves we've seen in the dollar, in stocks, in Bitcoin, in gold, some of those longer term trends to really understand cyclical patterns versus tactical patterns versus secular patterns, those big long term patterns, really, really valuable. Thanks again to Ian Reynolds for joining us from Brisbane. As promised, we'll include a link to his Substack, which he just got started, called, I think it's called Level Up. Now that I think about Limit Up, Limit Up. Great title, Ian. I love the throwback title to Market Maker days. By the way, if there are others that you'd like for me to interview as part of this Market Misbehavior podcast series, please drop a comment below wherever you're listening to this or watching it and let me know. Always open to approaching new guests like Ian and others with compelling perspectives and interesting stories to tell. By the way, if you want to learn more about some of the trend following tools that we alluded to, if you want to learn more about how to analyze some of the charts of gold, Bitcoin, the dollar, stocks, and other things that we shared on today's episode, our Market Misbehavior Premium memberships are designed to give you the tools you need and the education you need to make better decisions using technical analysis and behavioral finance. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses like Flight School, Behavioral Investing, where we teach you all about what's happening between your ears. That's called behavioral finance. And what tools and techniques you can use to better understand the markets. That's called technical analysis. And we'll teach you how you can combine the two in a meaningful way in what we call behavioral investing. Second, you'll have access to all of our members-only reports, like our weekly flight plan, which we put out every weekend, and our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, full and immediate access to our member community. For members only, I take a small subset of my followers as premium members, and we allow them to ask questions. They can exchange ideas. We share a lot of charts in the community, and it's a great sort of ongoing dialogue with a group of like-minded investors trying to navigate these markets just like you. For more information on our premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. From Market Misbehavior, I'm Dave Keller. Thanks so much for watching. Thanks for listening. And remember, it's always a good time to own good charts.